I will go ahead and jump in and give the official welcome. I'm Molly Bridges. I'm a senior event planner here at SoFi. We firstly just want to thank all of our SoFi members and guests for tuning in today for our Ask Me Anything with our very own Liz Young, SoFi's head of investment strategy.
Hi, everybody.
Lovely. Thanks again so much for joining us, Liz. Just a couple of housekeeping items. We will jump into the questions that you all have in just a moment. But if you have any additional questions for Liz, please keep those in the question icon down below on your Zoom screen. And we'll begin with the questions that people initially asked in our registration page, and then we'll work our way to our audience question if time permits. Feel free to engage with our Ask Me Anything by adding your comments and thoughts in our chat box down below. And as a reminder, this video is for informational purposes only, so please do not take this as financial advice. SoFi does, however, offer complimentary financial advice with one of our SoFi financial advisors. So let's go ahead and dig into those fun questions. Liz, thanks again for being here today. And we're just going to start off with one of the more basic investing questions, which is, what is the difference between auto and active investing, and how do I know which is right for me?
Yeah, that's a great one to start with. And I also wanted to just offer a big hello to everybody. This is my first real live member event, and I'm really excited to do it on behalf of SoFi. I'm excited to be here and answer your questions, and excited to do many more of these down the road. As far as housekeeping goes on my end, I know that everybody, when we talk about investing, really wants to ask about individual securities and wants to ask about SoFi's stock and any other particular stock that they're thinking about. I am limited for legal reasons and compliance reasons. I cannot talk about individual securities. So I'm happy to answer all the other questions, but I can't talk about individual stocks. So I just want to get that out there. So to answer the question, active versus auto investing, there are a lot of different ways to do both of those things. So I'm going to simplify with this answer, but auto investing is something that, and we might talk about this a little bit later too, about Robo-Advisors and kind of all the different ways that you can do auto investing. But basically auto is short for automatic. So it's something where technology is going to basically do the investing for you. And you might make regular contributions to an account, an investing account, similarly to what you would make to a retirement account, right? If it's taken directly out of your paycheck and it automatically goes into your retirement account, you can set up ways and different investments for that money to automatically go into. Active investing requires a little bit more attention and it takes a little bit more time. So auto investing will just happen on its own. You can even set things up in auto investing to rebalance the account for you, so you don't have to think about that. I think one of the big benefits of auto investing is that it takes that decision factor out of it. It takes the emotion out of it. It takes you questioning yourself out of it, and it just happens automatically. But active investing can be a really good option too, and it gives you a lot more flexibility. So you can make changes to your investments whenever you need to or whenever you want to. And that would be a more active approach. You can also take an active approach by investing in more specific things, right? So if you wanted to invest in individual securities or in some specific type of theme, that would probably be more of an active approach, kind of a hands-on approach, doing it yourself in the account.
Fantastic. Thanks for that explanation, Liz. Great. Another question that we have from our audience: how much money do you need to start investing?
Oh, how much money do you, I mean, very little today, which is different than what it was a long time ago. Or maybe when I started investing. I don't want to age myself. Maybe that wasn't that long ago. I wish it weren't that long ago. Unfortunately, it is. But you really don't need that much. And there's a lot of different options. I mean, SoFi actually offers options. You can buy fractional shares. Here's a good example of why we do that and why this question probably came up. There are certain shares of companies or even mutual funds or different types of investments that have a minimum investment, or maybe one share of a company that you want to buy costs $500 per share, maybe even $1,000 per share. There's companies out there that are $2,000 per share, right? And it can feel like, well, I don't have enough money to buy even one full share. I don't have enough money to buy 2 shares. And if I buy 1 share, that's all the money I have, right? So, and you don't want to do that either. So there are a lot of different options out there today. SoFi is one of them, where you can invest really small amounts of money at a time, and you can buy fractional shares. You can buy a bunch of different investment vehicles, things like exchange traded funds that have lower minimums. And what I would say to this is that the important part is just getting started. And I'll just tell a really quick story about when I got started in investing, because I think it's really important to think about. And even people like me had this lesson learned. I was, I think, 20 or 21 years old. I was working part-time at the time at a bank. I was a bank teller, and my boss tried to push me to enroll in the 401k program. And my paychecks were less than $100 every 2 weeks. And I thought I needed every penny of that, whatever it was, $85 every 2 weeks to do what a college kid does, right? And he kept hounding me about it and kept hounding me about it. And I said, I don't have enough money to invest in a 401k. I'm not even thinking about retirement. I haven't even started working. And just to get him off my back, I did it. I set it up. I put 6% aside, which was very little at the time. And it started to automatically go into my 401k account, which I'm not even sure I understood what that meant at the time. And I completely forgot about it. And when I left that job, they sent me the paperwork to roll over my balance into a new account. And I had like $1,200 somehow in a 401k account. So getting started was easy. I didn't even notice that the money was gone. It was such little amounts at a time that I didn't even notice it. And you get to a point where you realize the account has a balance, and you start to realize also that the investments are growing, and then it gets fun. It's exciting, and it's exciting to see your money work for you. So get started. Doesn't matter how big the account is. It can be as tiny as you have right now to offer.
I love that. Just get started. Just go ahead and put yourself out there, learn about it. Someone asked that they would love to learn more about investing with diversity and inclusion in mind. Any advice for going about that?
Sure. What's beautiful today about investing is that there's so much information available out there. Literally going online and just searching for ETFs that do focus on things like that. I can almost guarantee you that you're going to find something, right? It's a matter of making sure that number one, it's offered by a reputable ETF provider, and that it really is investing in what you want it to invest in. So let's take a step back and talk about ESG investing. The acronym ESG stands for environmental, social, and governance. Okay, not government, governance. So what that means is you've got a set of companies that are focused on the environment. This is maybe companies like clean energy companies, companies that are interested in climate change initiatives. You've got social, the social aspect of it. That's changed quite a bit over time. But some of the things that were mentioned here, diversity and inclusion, there might be companies that fall under that social aspect that do focus on diversity and inclusion. Also governance, what that means is companies boards, and we're looking at leadership and boards of companies. How are they governed? That's actually another place where you might find companies with diversity and inclusion mandates or initiatives, because they might have a requirement to have a certain number of diverse candidates on the board, or they might be very proud of the fact that they have a certain number of diverse candidates in leadership positions. So there's this whole movement around ESG investing. I do want to make a point though, because historically we used to always call it ESG investing, and it's changed over time. I won't bore everybody with the details and the history of how it's changed and what it was like 10 years ago when I used to talk about this more. But there used to be a lot of clients that were maybe Catholic diocese clients. Okay. So it used to be what we call a negative screen, meaning you would take something like an index, a set of companies, and you would just eliminate all the things that you didn't believe in. That's a negative screen. Now today, what ESG investing is more of a positive screen, meaning you create something that includes all of the companies that are deliberately doing those particular initiatives or deliberately focusing on those particular causes, okay? So ESG is kind of a term of the past. A lot of today's terminology and what you might hear more of, which means roughly the same thing, is SRI. and that stands for socially responsible investing. And you might find companies that are focused on diversity and inclusion in that box. You might also find companies that are focused on a lot of different social issues in that box. And then something that I think I mentioned earlier in passing, there's also another movement that's around values-based investing. And that's really just what it means is, as an investor, what are my values? Do I want to invest in companies, for example, that are focused on animal rights or, preventing animal cruelty? That's a values-based investing idea. And you can probably find a decent amount of options for companies that are focusing on that. So I hope that was clear. It's not just ESG, it's also SRI. You could also hear it called values-based investing, all kind of in the same universe though.
That's really helpful. That's a great clarification. Thanks, Liz. We did talk about a lot of the pros about investing and how you can have your values, but I think there is a bit of risk involved in investing. And so we have a lot of people wanting to know, what are those risks? What should they be prepared for? And how to mitigate those risks?
Yeah, there are a lot of risks. I mean, we could do an entire webinar on what all the risks are, and I still wouldn't cover them all. That's the nature of the beast. And that's also why we do it. And I don't mean to be so black and white about it, but it's sort of true, right? No risk, no reward. And there really is a spectrum and a direct relationship with the amount of risk and the amount of upside opportunity. There's also a direct relationship between the amount of risk and the amount that an asset could have volatility or have downside risk. So there's no way that I'll cover all the risks here, but what I'll say is this: I've worked with investors for a long time. I've worked with individual investors. I've worked with professional investors, and most investors define risk as losing money. That's it, full stop. If I've lost money, that was risk, right? That I understand. And that's why it's important to have diversification in the portfolio and have different asset types that when one zigs, the other zags, because then you lose less money in periods when the market broadly falls. But what I think one of the risks that people are taking today that I want to caution investors about, especially newer investors about, is concentration risk. And what I mean by that is having too many eggs in one or just a few baskets. So those baskets could be things like just big tech stocks, right? If we talk about the FAANG stocks, maybe we can talk about that a little bit later, the FAANG stocks. And if you have a lot of your account invested in just that particular basket, or if you have a lot of your account invested in just technology, right? It's not that technology doesn't have opportunity going forward. I absolutely believe that technology has opportunity going forward, but it's not always going to go up, right? So you want to have some other things, maybe some other sector exposures in the account that are going to act differently in different parts of the economic cycle and in different ways when the market does certain things. So concentration risk is a big thing that I want people to keep in mind. Take a look at your overall portfolio, take a look at your overall investments, and make sure that you're not too exposed to one particular stock, one particular basket of stocks, one particular sector, all of that. But other risks, there's different levels of risk for different investments. Small cap stocks are riskier than large cap stocks. Emerging market stocks are riskier than developed market stocks, right? And basically the higher the risk, yes, the higher the possible reward, but I would also say the longer your time horizon needs to be, right? Because then you can weather the storm. You can ride out some of those bumps. If you have a short time horizon, or if you're investing because you have a goal of something, let's say in 1 to 2 years, let's say you want to buy a house and you've got a chunk of money that you're investing to buy that house, but you want to buy that house in 1 year. That is not something that you're going to put a ton of small cap and emerging market stocks in, right? Because the volatility of it could cause you to have to sell at a point when the market just is not a good time to sell. So, the higher the risk, the longer your time horizon needs to be. Everything does have risk, but it's certainly on a spectrum. You're not going to escape risk in investing. Actually, risk is your friend most of the time in investing, but you do have to be aware of it and be careful of the concentration risk.
I think something you mentioned that actually also was a question was the difference between short-term and long-term capital gains, and perhaps the tax implications as well.
Yeah, yeah. So first of all, this is something that I constantly kind of struggle with internally, mentally. So I'm going to just PSA, right? Public service announcement up front. If you're paying a capital gains tax, that means that you made money. Okay, so that's a good thing. And I understand that capital gains taxes can be a drag and they can be a real bummer, and they get a lot of talk in media and politics, and there's a lot of fighting that happens in Washington about capital gains taxes. As an investor, though, if you have to pay a capital gains tax, it means your stock went up. So that's a good thing. You would rather have to pay a capital gains tax than be saying, oh, I lost so much money and I can use that loss to offset something else. That's not a good situation. So capital gains taxes happen because something positive happened in your account. Okay. Short-term capital gains are something that are triggered if you bought and sold the same investment within 1 year. So in less than a year, if you only held it for 9 months, 6 months, 11 and a half months, okay, less than a year, that's a short-term capital gain. So let's say you bought something at 50, it went up to 100, you pay a short-term capital gains tax on that $50 gain, okay? The reason that we distinguish between short-term and long-term is because the tax rate on short-term gains is higher than the tax rate on long-term gains. So you might pay more tax, you will pay more tax on a short-term capital gain than you will on a long-term capital gain. So it pays to hold it longer from a tax perspective. Long-term capital gains are just beyond 1 year. So let's that same example, you bought something at 50, it went up to 100, you held it for 1.5 years. You now pay a long-term capital gains tax on that $50 gain, which is a lower tax rate than the short-term capital gains tax rate, okay? So it basically encourages you to not move in and out of positions very often. And I would actually also encourage you to not move in and out of positions very often, because it can be a really tricky thing. Number one, nobody knows how to time the market. If somebody finds someone who knows how to time the market, I want to meet them. But if somebody had figured this out by now, how to time the market, people like me would not be here. So nobody really knows how to do that. It is a really tough thing to do. And there is nothing in life that will humble you more, or at least nothing in investing that will humble you more than the stock market. It will tell you on a repeated basis that you were wrong. So don't try to be right about that. But the idea behind having a short-term gain or short-term capital gain tax that's higher is also to encourage you to not do that, right? So hold things for the long haul, stick to the plan. Don't be tempted to move around your stock, your positions, or trade around your positions more often than you really should.
That's great advice. We're going to do a quick vocabulary session to help us define some of these terms.
Okay.
Okay, so you mentioned FAANG stocks. Do you want to quickly define that?
Yep, FAANG stock. So FAANG, the way that we say it is FAANG, spelled F-A-A-N-G. And what it historically stood for, I believe Jim Cramer from CNBC is the one who came up with that. What it historically stood for was Facebook, Apple, Amazon, Netflix, and Google. One thing to note, Google is actually called Alphabet. Okay, so if you look up, the ticker is G-O-O-G, but the stock itself is actually called Alphabet, but the G stands for Google. It's very confusing because, FANA didn't sound the same. so it's FAANG, right? But now actually what's happened, because Netflix, basically the reason that was coined was because they were the 5 largest stocks in the S&P 500. Now Microsoft has replaced Netflix. I cannot say what that word, I don't know. I can't make my mouth do that. So it'd be F-A-A-M-G, FEMG, something like that. But basically still Facebook, Apple, Amazon, Microsoft, and Google. And the reason that they were put into a group was to represent big tech stocks. Obviously, there's been a lot of activity around big tech stocks since this global pandemic and all of the stay-at-homeness and everything that we did. That's why Netflix was in there before and was talked about much more. Microsoft now gets talked about a little bit more. But they were put in that basket because those were the stocks that won last year. And if anybody, if you wanted to come back to me and say, well, concentration risk, you said don't be overly concentrated. But last year, if I would have been overly concentrated in the FAANG stocks, I would have really won.
Mm-hmm.
That's true. You would have. And I would have to say, yep, okay, last year concentration actually did benefit you. That is not the case every year. And that's what I mean about trying to time it. So if you know when to call that inflection point to get out of your FAANG stocks and into a more diversified portfolio, by all means, go on with your bad self. But it is a really tough thing to do. So it is much more prudent. It is much more responsible, and it's probably easier to meet your goals and stay on track if you have a diversified portfolio that isn't practicing some of those little bets.
That's fair. That's a great explanation. And you mentioned timing. So what is the explanation around a bear market, a correction, and a recession? How do those play out in the timing of all things stock market?
Yeah, it's funny because people like me throw those words around all the time. We talk about corrections, we talk about bear markets, we talk about recessions. There's actual definitions for what those mean. So these are like little facts that you can dazzle people with at your next party or barbecue. A correction is defined as a drawdown of 10%. Okay. A bear market, or roughly 10%, so, and 10% or less would be a correction. Even 10%, 10 to 15%, getting up towards 20%, still technically defined as a correction. Okay. A bear market is defined as a drawdown of 20% or more. Okay. So it doesn't actually qualify as a bear until there's been a drawdown of 20%. And when I say drawdown, I mean peak to trough. So intra-year, not necessarily, one particular year that posts a certain decline. It's peak to trough. It could happen from March 27th to April 16th, right? It could be something like that. And a bear market has to be a drawdown of 20% or more. Okay. So when you hear those terms, that's what they mean. Also, notice just the word correction, right? Implies that it's something that is brief, something that is correcting an imbalance that existed before. And on average, every single year, on average, we have a correction of about 14.5%. Okay, that's the long-term average. We have not seen one of those this year. I'm not saying that that's coming. It doesn't mean that we have to have a correction of 14.5% every single year, but on average, that's about what happens. So I say that because I think that there are a lot of investors that maybe got newer, they were into the market as newer investors after the pandemic. They haven't seen a drawdown, really. They haven't seen something like that. They haven't lived through that. And I'm here to tell you that it's normal for things like that to happen. Now, bear markets occur when there's something else wrong, typically. And usually you get to that down 25%, 30%, 35%, 40% when it's coupled with some sort of shock. For example, COVID-19, right? This pandemic took us down 34% very quickly, faster than ever before. So that's a bear market coupled with a shock. There's also bear markets that result maybe not necessarily due to a shock, but due to a recession. So when you couple it with a recession, you see a bear market that's in that 25, 35, 40% range, okay? So that's what those mean. A recession is defined as 2 consecutive quarters of negative GDP growth, or said another way, 2 consecutive quarters of GDP contraction. GDP is gross domestic product, just the measure of what our economy produces, puts out into the world. There's all different components, which we're not going to get into here, but it's the measure of like what we do as the United States of America, right? As production. So 2 consecutive quarters of contraction in GDP would be defined as a recession.
Great. That was really helpful. Thanks for walking us through that one. We have a couple more questions, and then we'll go back to the chat and see what we have from our audience. But a last question from our initial pool was dollar cost averaging. What is it, and is it a good way to invest?
So dollar cost averaging is basically a systematic way to invest a chunk of money. So let's say you've got $1,000. Let's say $10,000 just to make the math easy for me. Let's say you've got $10,000 and you want to invest it in the stock market over the next 6 months or so. You could either take that entire $10,000 and put it in today, or you could take $1,000 and put it in 10 different periods. Okay. The reason, and so putting it in 10 different periods is what dollar cost averaging is. The reason you do that is because, number one, it minimizes the risk of timing the market wrong. If I put it all in today, let's say the market was down today, I put it all in today, I'm locked in at that price at whatever today's price was. If I average it in smaller chunks over time, the average price that I get those investments at is going to be a little bit more smooth, and it'll take into account some of the movements that the market has made in the meantime. So it takes out some of that timing risk. It also takes out, honestly, it takes out the emotional part of it, where you're trying to figure out what's the right time, what's the right amount. Just do it in a systematic way, get it in the market. If you have a long time horizon, just get it in. It's not going to matter 6 days versus 4 days later, right? Just get it in the market in a systematic way. That's what dollar cost averaging is. That's why people typically say to do it that way.
Great, that was really helpful. Michael from our audience here asks more about Robo-Advisors. Can you share more about that?
Yeah, so Robo-Advisors are a reasonably new offering in the marketplace or in the investing landscape. Kind of named funny because there's not actually an advisor, and there's not a robot either. It's all technology based. But an example of what a robo-advisor would be is, let's say you went to open an account on a brokerage platform or a trading platform, an investing platform, and you start to open the account. It asks you a number of questions. It asks you things like, what's your risk tolerance? What's your time horizon? It asks you all kinds of questions, and every platform is going to ask you different questions. That is part of an input into a robo-advisor platform. So what it's doing is it's trying to figure out, from a technology standpoint, from an auto standpoint, there's an algorithm that's behind it. That's trying to figure out, okay, what kinds of investments or what kind of portfolio, what kind of risk tolerance, what kind of return expectation would this investor fit into? So it's kind of trying to put you into a certain category based on your answers to those questions. And then the algorithm, so the technology behind it, would put you into a certain type of portfolio. It might put you into, I'll call it a moderate portfolio. Okay, a moderate portfolio might be 60% stocks and 40% bonds. These are very simple examples. I'm not telling anybody that they should do this, but just as an example. So a moderate portfolio, based on your answers, it would put you into that. And a robo-advisor also typically has portfolios that they've populated with some investments, maybe just some ETFs, to track certain different types of markets. And they would just automatically invest you into that particular portfolio. So the idea here is that it does an element of financial planning for you, because it's asked you the questions about your financial picture. It does the investing for you automatically. We talked about that earlier, auto versus active investing. And it's something that typically should be cheaper than going to a full service financial advisor, right? You're just not getting that one-on-one sitting at a desk talking to an advisor approach.
Liz, just wanted to give you another thank you for joining us today. That was so informative and extremely helpful. Thank you so much for your time.
Thank you. Thank you for all your questions, everybody.
Amazing. And thanks to all of our SoFi members and SoFi guests. We have other events for you in your SoFi app under member experiences. Enjoy the rest of your Wednesday, and we'll see you back at another event soon. Thanks so much, everyone.